Welcome to Bloomberg Markets. I'm Scarlett Fu. What a difference a week makes. If you look at the broad markets, U.S. stocks do continue to stabilize, with both the S&P 500 and the NASDAQ moving higher for a third day. There's a sense of calm here that seems to have been restored at the moment. You can see VIX is below 20 once again, compared with an intraday high of 65 last Monday. But it's worth noting that even with the gain in the S&P 500, that is largely on the back of technology. Little change right now in yields across the curve, but we do see the 10-year right now at 3.91%, still holding below 4%. And the yen, which was, of course, the epicenter, ground zero for the meltdown last Monday, is weaker against all 16 major currencies. Currently, the dollar higher by about 0.5% against the yen. All right, let's get you some midday movers on the equity side. Starbucks gaining on a report that activist investor Starboard Value has now taken an undisclosed stake in this company. The latest earnings report we heard from Starbucks showed that the company is really struggling with a slowdown in demand, along with pressure from its existing activist investor in there, Elliott Management. Meanwhile, take a look at Hawaiian Electric, plunging down 15% after it issued a going concern warning, pegging liability losses from the 2023 Maui wildfires at $1.7 billion. Last week, the utility agreed to pay almost $2 billion as part of a settlement to resolve hundreds of lawsuits over wildfires in Lahaina. Now, for this week, investors are anticipating a slew of market-moving economic data, and for those who are nervous, perhaps another shoe to drop. This week alone, we're going to get wholesale inflation, that's PPI, due out tomorrow, then consumer inflation, CPI, on Wednesday, followed by retail sales, plus weekly jobless claims on Thursday. And then on Friday, we get housing starts and Michigan sentiment. Here's Federated Hermes CIO earlier today.
We're looking really at 50 basis points for the rest of the year. Outside chance of 75, but unlikely that even that will occur, because I think the Fed does not want to signal that they're wrong and that there's a bit of a panic and that they need to move faster than anticipated, unless they truly believe inflation is under control and the market is slowing in a way, the economy is slowing in a way that I think at this point is not expected.
Okay, so joining us with an outlook now for the economic data that is on the calendar is Bloomberg economist Stuart Paul. Stuart, it is good to speak with you. These economic releases would be a big deal at any time, given we're talking about wholesale inflation, consumer inflation, but they really take on extra importance this time around because of the fragility of investor sentiment following last week's market meltdown. What's the mood like heading into this week's releases? Have you seen a lot of negative adjustments to the data points?
We haven't seen broad-based adjustments to the data points. We've seen some upward revisions of other folks in the sell side revising up their expectations for, say, recession risk. We think that the data this week is really going to highlight stagflation risk, which is where the narrative was before we saw the jobs report that showed the uptick in unemployment to 4.3%. We're expecting to see an uptick in the monthly pace of inflation, of headline inflation and core inflation. That'll still allow the annual measures to come in, which folks might celebrate. The thing that's going to matter most when we look at both wholesale and consumer price inflation is what the composition looks like. And I think that we're going to see some underlying factors in both the CPI and PPI reports that end up feeding into the core PCE inflation measure, which matters most for the Fed. And it could actually cause an uptick in the annual pace of core PCE inflation, which will be the last one the Fed sees before the September meeting. And again, that could be the difference between a 25 and a 50 basis point cut.
Okay, fascinating. Normally, we know that CPI comes first and then PPI gets released, but the release this time is the other way around. How will the earlier release of PPI shape the market's expectations, do you think, for CPI when it does come out?
I think that it's possible that it could lull markets into a little bit of a sense of complacency. I think that we're going to see a slowing in the monthly pace of PPI inflation from 0.4% month on month in June to 0.2% month on month in July. That, again, could allow investors to breathe a little bit of a sigh of relief. Inflation is coming down, but we are going to see that uptick in the pace of inflation in CPI coming out on Wednesday. That's going to be a little bit of a whipsaw for folks' sentiment and investor sentiment across the 2 days.
Okay, so it's good to know that right now heading into these data points. Of course, we also have retail sales, and there's a lot of questions about how tapped out the consumer is, especially given the earnings reports that we've gotten so far. They surprised to the downside last month, due in part to the cyber attack on auto dealers. So do you think the July report is going to show a bit of catch-up, therefore? I
think so. I think that we're going to see 0.4% month-on-month retail sales growth. That is going to be because of catch-up spending at auto dealers as car buyers went back to the lot. We also saw an increase in gasoline prices during the month. We actually saw a very peculiar decline in gasoline prices in June, which weighed on retail sales. If we look under the hood, to extend the automobile analogy just a little bit in autos, if we look under the hood and we look at the control group, which strips out gasoline, autos, building materials, some of the more volatile components, also strips out food services, and we really look at the core of retail sales, I think that we're going to see softness. We're going to see consumers that are looking for deals online. We're going to see consumers that are really tightening their belts. Absolutely. All right. Well, that has fed into this recession narrative as well. We know that the July jobs report was kind of the thing that got everyone talking about it once again. Industrial production is also a key indicator for NBER, which is the organization that officially declares recession months after the fact. We get July industrial production on Thursday, which feels like an afterthought compared to the other data points. What should we be expecting for that? I think that we're going to see a relatively weak industrial production number. Manufacturing is really the backbone of industrial production, and the ISM survey data surprised to the downside. We saw the aggregate number of hours worked for both non-durable and durable manufacturing producers declining during the month. The stage is really set for a 0.3% decline in manufacturing production. We could see the headline IP, the headline industrial production number, a little less dismal. We could see a 0.1 or 0.2% decline, but that would mostly be because of utilities output and energy extraction. And part of that is really just because of an unseasonably warm July. And when that's the case, seasonal factors don't fully take that into account. And so the headline might not be as bad as the manufacturing number, which is really what we care about. Stuart, really appreciate your giving us a rundown of what to look for this week, a critical week for economic data. Bloomberg economist Stuart Paul. Coming up, B. Riley shares plummeting as the SEC looks into the financial firm's disclosures to investors. We're going to dig into that one. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Goldman Sachs says investors will have a brief window to buy the dip in U.S. stocks at the end of August, and it all has to do with systematic funds. Bloomberg's Natalia Kanejevich is the authority on positioning and has the details for us. Natalia.
Hi, Scarlett. So we do see that systematic funds sold U.S. and global stocks pretty aggressively, not just during the past week, but over the past few weeks. This chart shows systematic funds, which include vol control funds, CTAs, risk parity, and the S&P 500. So we see that this huge drop down. So those funds, they typically follow market signals, volatility, rather than fundamentals. And it's really important to keep an eye on that. Goldman Sachs is saying that those funds, they sold about 108 billion of global stocks. It may sound like it's not such a huge number when we compare, for example, with market cap of the S&P 500. However, when they start selling, you really feel that. So where do we go from here? Goldman Sachs, Scott Robner, who basically was correct when he predicted this latest sell-off, he is getting more tactically bullish, and he sees a small window of an opportunity to buy the dip, starting from August 30th till early September. Two reasons behind that. First of all, systematic funds positioning is not as stretched as it used to be. And secondly, buybacks, corporate buybacks will also help stocks move higher. But however, Scarlett, he's being quite cautious, and he's saying that when this buyback window closes on September 6th, he sees more volatility ahead, first of all, because of fund flows and flows into the equity market, and secondly, some anxiety around the U.S. presidential elections.
It always comes back to that anxiety. Natalia, thank you so much. Great setup here. And of course, as investors buy the dip, one stock investors are buying right now is Keycorp, and it is our stock of the hour. This comes as Bank of Nova Scotia, better known as Scotiabank, has agreed to buy a minority stake in the regional lender. Joining us for more right now is Bloomberg's Christine Dobby, who covers finance for us in Toronto. Christine, thank you so much for speaking with us. What's the strategy here for Scotiabank? I see that it's got one of the biggest international footprints of the Canadian lenders.
Hi, Scarlett. Yes, that's right. Scotia has long been known for having a very big international footprint, but unlike many of its Canadian peers, it hasn't had a huge footprint in the United States. Instead, it's had significant investments in Latin America and the Caribbean. And under Scotia's relatively new CEO, Scott Thompson, the bank has done a strategic review and they've looked at repositioning their capital deployment. They're reevaluating a number of their Latin American investments, which have been underwhelming, and they're trying to put more into North America, primarily Canada, the United States, and Mexico.
Okay, so that's the look from Scotiabank. What does this do for Keycorp? Because the deal will dilute Keycorp shareholders, but you look at the stock and investors seem positive. So there's got to be some advantages that they see here.
Absolutely. If you'll recall, Keycorp was one of the banks, the regional banks that got hit quite hard last year during the regional bank crisis in the United States. And part of the reason for that was a very high cost of funding. And so the bank has been working to reposition its balance sheet. And CEO Christopher Goldman said today that they'll use about half of the proceeds that they get from the Scotiabank deal to reposition the securities that they own towards shorter duration, higher yielding securities. And so because of they'll be changing the cost of funding, they hope to see a significant increase in their net interest income, which is part of why you're seeing investors really loving the deal for Keycorp today.
Yeah, the stock up about 9.5% at the moment. Christine, thank you so much for joining us. Christine Dobby in Toronto. We're also closely watching another financial firm, shares of B. Riley. The founder, Bryant Riley, says he and the firms received subpoenas from the SEC. Investigators are looking into whether B. Riley gave investors an accurate picture of its financial health. The stock is tumbling as a result. Bloomberg's David Voriakis joins us. So, David, Bloomberg reported today the SEC widened its investigation of this firm. What exactly or what precisely is the agency investigating?
Well, we reported that the SEC is looking at whether B. Riley accurately disclosed its financial challenges, whether it properly told investors about receivables underlying many of its financial transactions. And we also reported that they're looking at possible insider trading. And so this is a broadening of previous reporting that we had done about the SEC investigation. Another big aspect of it is the relationship between Bryant Riley, the founder of the firm, and Brian Kahn, who is the former CEO of a company called Franchise Group, which B. Riley helped take public a few years ago and then helped take private again last summer.
Okay, so it's done business with it. Is that the extent of their relationship?
They've done business for many years together, the two of them, in a variety of different businesses, and there's a number of loans and receivables going back that tie those two together. Kahn is of interest because federal prosecutors in New Jersey said that he was an unindicted co-conspirator in a $294 million investment fraud involving a firm called Prophecy Asset Management. Now, B. Riley, the company, has said they had no knowledge of any wrongdoing by Brian Kahn. They had nothing to do with it. But the market, of course, is punishing them pretty badly today.
I mean, this is a spider web of relationships that the SEC is investigating, and none of it sounds great the way that you're describing it, how there's these linkages. Where do things stand right now in terms of this is a story you've been reporting on for a while? Does it feel like you're getting to a point where the shoe is dropping, or does it still have a long way to go?
It's not entirely clear how long the investigators, the SEC and the prosecutors will continue their work, but investors seem to be moving quickly.
Yeah.
The debt for FRG has been downgraded again, and there's questions about some of the underlying loans, so they may outpace the investigators from the U.S. government.
So in other words, sell first, ask questions later. David Vouriakis.
Quite possibly.
Thank you so much. David Vouriakis, of course, on the beat here on B. Riley, whose shares are down by half today. Coming up, Bloomberg taking a special look at the next big risks. Citadel's head of economic research gives us a warning about Europe's economy. We'll dig into all of that. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. One of the most important things to watch for in the next few years, the strength and sustainability of Europe's economy. That's according to Citadel's head of economic research for fixed income and macro, Angel Ubide. He spoke with Bloomberg's Sonali Basak for her next big risk series.
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
its own bank,
its own large energy companies. Why? Because they want to have national control. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, are going to generate more growth, more jobs, more welfare, but you are going to have less control at the national level.
Is what worries you the direction of travel has been the exact opposite of what you're describing?
There has not been progress in that direction, right? And I think in some sense it's the legacy of the European crisis. It was very scary to see the default in Greece. It was very scary to see the sudden stop of capital inflows in some of these countries. And so there was a bit of a decision to self-insure. How do you self-insure? You have your own bank, your own telecom, your own energy. And I think that's the issue. There is still a little bit of this fear from the last decade that is a little bit blocking the thinking about moving forward.
When you describe a weaker Europe, you're describing a world that is becoming more bipolar.
It's becoming more bipolar between the US and China, yes.
What is the ramification of that?
Well, I think what it means is that it's less global and more bipolar. So I'll give you another example, right? And I used to work at the IMF. The IMF is a global institution. Could we be going in a direction in which countries essentially see an institution like the IMF more of a Western institution? And then China and its pole of influence essentially withdraws from that and decides to run its relationships in a different way. We have seen a little bit of that on the debate on the common framework and some of the issue of sovereign debt in less developed countries. We could be going in that direction if Europe weakens.
It sounds like it would also then be harder to resolve conflict, both security as well as economic.
It gets more difficult because if we don't have a shared sense of what the rules are, as it's been happening, for example, with the WTO, then what is the forum to resolve this conflict?
Well, draw that out a little more. You've named a couple organizations, let's say the IMF, WTO, World Trade Organization. Let's also add NATO into this mix. What does it mean for all of these organizations?
So NATO is another example, but it goes back a little bit to what I was saying about self-insurance, right? The world is better off if there is a common project and there are joint interests. If there isn't a common project and there are no joint interests, then each country says, I'll take care of myself and I will do more self-insurance. Self-insurance is less optimal.
Sonali joins me now. Usually when we talk about the world, everyone splits it up into Team China or Team USA. It's interesting that he brings up Europe as its own team.
I was thinking the exact same thing. When you think about his argument here, his worry here is that if Europe starts to become weaker, then all of a sudden that debate between US and China becomes way more stark, doesn't it? And if you think about the trade flows, there are a lot of reasons that you would think many nations in Europe would still be beholden to China, really forcing them to choose which side. What's more is there was an inkling here that he was talking about where big multilateral organizations, the IMF, NATO even. How strong can they be if Europe begins to weaken at a greater scale? With these populist forces really underway in many countries in Europe, it becomes difficult to then unify Europe as a whole, doesn't it? There are very nationalist forces there. But at the same time, he's arguing for that greater Europe, for that common prosperity, hard to do in an environment that we see right now.
I guess the question is Europe ready to work together? Because not so long ago, people in Germany were not too excited about the prospect of subsidizing what was happening in Greece, for instance.
Yeah, and that's the example he brings up with Greece as well. The other example he brings up that I think is also very relevant to today, you saw it with the IMF, the common framework that is used for debt restructuring for, let's say, indebted kind of third world nations in particular, where China can often be the holdout and the success or lack thereof in many instances. So this comes down to a broader discussion, which we heard also by Guggenheim's Ann Walsh, this worry about nations being too indebted, even the United States being too indebted. But what does this mean in a world that's flush with debt?
Absolutely. Shonali, fantastic work here. And of course, you can catch Shonali's full Next Big Risk column on Bloomberg.com and on the terminal. I'm Scarlett Fu. That does it for Bloomberg Markets. We are looking at an S&P 500 that is up marginally, up by 0.2% at the moment here. The Nasdaq gaining even more ground, 0.5%. So this is largely an advance in equity markets that's being driven by technology. There's not much move on the Treasury curve. The 10-year yield is still holding below 4%, 3.91%. The yen losing ground once again versus all 16 major currencies. From New York, this is Bloomberg.